Hello students, welcome to this lecture. Today we are looking at monetary policy, the definition, the objectives and types and tools of monetary policy. So let's get started. So we need to know what is monetary policy. So monetary policy, we are looking at the action taken by the country's central bank or monetary authorities to control and regulate its money supply and interest rate. So monetary policy can involve manipulating the interest rate. Monetary policy can involve manipulating the money supply and also manipulating even the exchange rate, because we're looking at a demand-side policy that is being used by central banks or monetary policy committee or authorities that control and regulate the money supply in the economy. So we are saying that it aims to achieve specific economic objectives. We might end up having a recession, or there might be inflation getting too high, so they might intervene and try to reduce inflation by using the monetary policy tools. So we are looking at the idea that such as price stability, full employment, sustainable growth, economic growth are all some of the key macroeconomic objectives that we can target by using the monetary policy tools. So we are saying that as central bank, they are supposed to use these various tools to implement monetary policy, including open market operation, reserve requirement, and discount rate. We're going to be looking at what open market operations are and what is reserve requirement, what is also the discount rate. So this is what monetary policy is. It's an action by the country's central bank or monetary authority to control and regulate its money supply and interest rates. Um, so let's look at open market operations. So we're saying that what we call open market operations, whereby central banks themselves are the one who buy and sell government securities in the open market to influence the money supply. So they buy government securities in the open market so that they can influence the money supply, the velocity of money circulating in the economy, the circulation of money in the economy. So we're saying that by buying securities, they're injecting money into the system in the economy. When they are selling the securities, they are removing money out of the economy. So by injecting money, maybe they are trying to stimulate economic growth. Also by selling those securities, they are trying to reduce the money supply, removing money out of circulation. They want to reduce inflation. So this is how they use the open market operations, whereby they sell securities on the open market as a way to try to influence the money supply. Then you have what you call reserve requirement. So we're looking at the central banks themselves. They have what you call the minimum amount of reserves that bank must hold. So that they have a minimum requirement that they require central banks or what can I say, commercial banks to hold in account with the central bank. So we're saying that changing these requirements affect the amount of money banks can lend, impacting the overall money supply. So we're saying that this reserve requirement are usually, so some countries 10%. So we're saying that the amount of money banks can lend is influenced by this minimum amount of reserve requirement, which are being held by the central bank. So this is going to impact the overall money supply in the economy. So this might be intention to reduce the money supply, or they might reduce even increase the reserve requirement as a way to increase the money supply. So we have to look at the idea that if we are there um, and wanting to reduce the overall money supply, they just have to uh, look at the reserve requirement and increase the reserve requirement, reduce the reserve requirement. If they want to reduce uh, the money supply, they just have to influence even the reserve requirement, because it's the one that is intended to influence the overall money supply. So that's very important for you to know the amount of bank must hold, that minimum amount. That is what's called the reserve requirement. So if the reserve requirement is high, which means there's be less money in circulation. When the reserve requirement is lower, which means more money in the circulation, banks can lend more money. Okay, then we have what you call the discount rate. We are saying that this is the interest rate at which commercial bank can borrow funds directly from the central bank. So we're looking at the interest rate that they are charged for them borrowing money from the central bank, directly from the central bank. So we're talking about is there's changes in the discount rate that will influence the cost of borrowing from banks, and can impact even the lending and the spending uh, that will take place in the economy. So we are saying that if the discount rate um, has been increased, which means that the interest rate that the banks have to pay for borrowing money from the central bank is going to be much higher. So central commercial banks are more likely to borrow less money, but when the discount rate is lower, they are more likely to borrow more money in the commercial banks and lend it to their customers. So that's what you have to understand. That's also going to influence the overall impact of spending in the economy, because this is all governed by the central bank. The discount rate of the central bank determines the commercial bank borrowing power. The borrowing power of those central of these commercial banks from them is going to impact even the lending and the spending in the economy. So you have to look at the idea of what to call the discount uh, rate. Okay. So we have what to call so-called interest rate, which is a very most important tool of monetary policy. Whereby we are saying that central banks themselves use interest rate. Yes, interest rate is the cost of borrowing and the rate of return on savings. So we're saying that the federal fund rate is the in the US interest rates to influence overall level of interest rate in the economy. So we're more likely going to see that when there's a lower rate, they encourage more borrowing and spending. But when the rates are higher, um, while higher rates can curb inflation, which means when there's higher rates, this is whereby they're trying to reduce inflation in the economy. When there's lower rates, that increase the borrowing and spending of banks, even the consumers themselves, they have much more borrowing power. So we have to look at interest rates being a fundamental tool of monetary policy that can be used to curb inflation. We use higher rates to curb inflation, because higher interest rates means the cost of borrowing is much more higher. So commercial banks are more likely to borrow less money from those. So there will be less money in circulation, thereby reducing the money supply of the currency in the economy, thereby reducing the price level, thereby reducing inflation. Then in conclusion, we talked about open market operation, talk about discount rate. So we have to understand that monetary policy itself, we are looking at is a demand side policy, of course, but we are talking about displays a crucial role in stabilizing the economy by adjusting the availability and the cost of money, because this is the two things that are crucial for running an economy. Because by adjusting the availability and the cost of money, they're going to influence demand supply, how money is being supplied in the economy, how money is circulating in the economy is being influenced by these monetary policy tools. So they're able to influence even the economic activities themselves, looking at how we're looking at stabilizing the economy and reducing inflation. But this is all in line with the availability and the cost of money. So it is a tool for central banks to respond to economic conditions such as inflation, recession, or financial instability, or aim to foster sustainable economic growth. Look at the issue of fostering sustainable economic growth, which means you will be reducing, let's say, the interest rate, which means the cost of borrowing will be low, encouraging more commercial banks to borrow money, looking at discount rate, looking at all those things that we're talking about, the tools of monetary policy. So it's very crucial for you to know that the monetary policy is controlled by the central banks, and it involves manipulating the interest rate and the money supply. And also, it is a minor branch, which is in the exchange rate. So this is what you have to know about the monetary policy. So thank you so much for watching this video. I'll see you in the next video.